Hi there folks, and welcome to the first of our video lessons for our first trimester of Year 10 Accounting. And this one is on our first topic, which is just an introduction to some basic principles of businesses and some terms and things that you'll need to know about. One of the things that you'll need to get used to with any study of accounting is it's kind of like learning another language. Now, there's lots of words and lots of things that you've not really heard of too much before. It's a bit like walking into French, for instance, for the first time and hearing all of these things and you're not quite familiar. So take a little bit of time. But if you put a little bit of effort and concentrate on some of these terms and understand them, then that'll make your accounting studies a lot easier, and things to come will seem so much more obvious to you, and you'll understand them. So it really is worth the effort of understanding these basic sort of concepts and some of these words that we'll talk about. So we'll move straight on. And the first thing we really want to talk about is actually what a business is. And when we define a business, there's 2 points there that you'll see. And it's a business is an enterprise carried on with a view to earning a profit. Now, enterprise is an interesting word. If any Star Trek fans, you'll know about Enterprise, the Star Trek Enterprise. You guys are probably too young for that. But a business being an enterprise really talks about an organisation. An enterprise really is a word that describes an organisation. So a business is an organisation, and it's an organisation that is it exists to earn a profit. People don't start businesses unless they're looking to earn a profit. That's what the whole concept is, and we call that the profit motive. They are motivated by profit. The motivation for starting and putting in all that effort and time and money to starting and running a business, it's all about those people earning a profit and earning money, taking their investment and making more money as a result of that, because whatever it is that the business does. So business is an enterprise, and it exists to make a profit. That's a really important thing. There are other types of businesses out there, or they're not really businesses, sorry, there are other types of enterprises that exist that aren't really businesses as such because they don't have that profit motive. So things like charity organisations, like Caritas is one that you guys hear about a lot, and the Red Cross, these types of organisations, they don't exist to make a profit. That's not what they're about. They're there to provide some sort of service or to help people, right? They don't charge generally for their services. And even if they do charge for their services, the whole idea is really just to cover their costs. It's not to make a profit. So businesses, to be classified as a business, or an enterprise to be classified as a business, it really needs to have that profit motive and be motivated by profit. Whether it's a business enterprise or whether it's some other type of enterprise, though, all of them interact with people, and they all have suppliers and customers, and people that they deal with and trade with. All of those events that involve some sort of exchange of money or currency, we call those things financial events. Any event that occurs that money is involved in some way is called a business transaction. So all businesses have transactions. Whenever they sell something, whenever they buy something, all of those things are financial events. They all involve money, and we call those things transactions. Down the road, we'll do a whole topic on analysing transactions. That'll be something that we'll talk about a lot. And why do we have this accounting thing anyway? What's the purpose of accounting? Well, a little bit of a definition there. And the purpose of accounting is to identify, measure, interpret and communicate financial information to interested parties. So as an accountant, that's our job. Our job is to identify, firstly, that some financial event has occurred. Oh, there's something that's happened that's involved money. So we identify that. What is it? What's involved in that event? What things have been impacted? We try to measure that. Right? Usually in dollar terms. You measure things in accounting mostly in dollar terms. So how much has that event been worth? Then we try to interpret, well, what's happened? Well, we've identified something's happened. What is it that we know how much it was for, but what is it that's actually gone on there? Sometimes that's relatively simple. Sometimes that's really, really complex. Thankfully for you, I suppose, we'll be concentrating really just mainly on the more simple things in this introductory to accounting unit. And most importantly, though, we communicate. there's no point as accountants doing any of this stuff unless we tell people what the result was, what we found. So it's about communicating the information that we come up with and that we identify and measure and interpret back to these people that we've called interested parties, which is another term, another accounting term. Well, what's an interested party? Well, an interested party is anybody who might be interested in the performance or the financial results of our business. So that can include things like the owner. Obviously, our owner or owners are interested in how a business is going. All right? In some businesses, there are multiple owners, and they might be called partners, or in really big businesses, they might be called shareholders. All of those people are owners of the business, though. People we owe money to might be interested. Our employees, they're probably pretty interested because they want to know if they're going to get paid or not. Government is interested because businesses, like people, pay taxes and collect taxes like GST on behalf of the government. So there's lots of parties or people that are interested in this financial information that we identify, measure, interpret, and communicate as accountants. Our whole system of accounting is underpinned by a set of some basic assumptions, and there are a number of them, but we're really only going to focus on two important ones, at least for now. And that is this thing called the accounting entity assumption. We talked about the owner as being an interested party in the business, which highlights the point that the owner and the business, or the owners, if there are more than one of them, and the business are not the same. They are separate, and we use this word entity to describe a body. A person can be an entity. A business can be an entity. A whole organisation can be an entity. But we describe a business as separate from its owners. And as accountants, we are interested in the business. When we look at the financial records, we are looking at the financial information of the business, not of the owner. There is a very clear difference and distinction there, and accounting is concerned with the business, not with the owner. And we'll have a little bit more of a look at how the owner is important to the business and how that relationship works a bit later. But it's important you understand that the accounting entity assumption separates those two entities, business from the owner, and we're interested in the business. The accounting period assumption is the other one to be aware of. The life of any business is broken up. We break it up into little chunks, and we communicate our financial information at the ends of these periods. Depending on the size of the business, those periods can be quite short. They might be weekly or monthly in really big businesses. But the basic period is what we call the financial year. And we do it not in a calendar year. Right? There's lots of things happening at the end of a normal calendar year, around Christmas time and holidays and so on. So that's really quite a busy period, and not really a good time for accountants, because of the amount of stuff to be done, to be doing all of that and communicating the results of the business performance for that year. So we have this thing called the financial year, which starts on the 1st of July each year and carries through until the 30th of June the following year. And that is what we call the financial year, and that's a really important period of time for accountants. And lots of things happen around that 30th of June period. You see lots of things called stock take sales and all this kind of stuff happening in June every year. And there's lots of really good reasons for that. And it's all to do with this accounting period assumption, which has this concept of a financial year ending at the 30th of June every year, having started the 1st of July the previous year. So they're two fundamental accounting assumptions that really underpin a lot of things we do in accounting, and they make they'll make a bit more sense later on as we talk about some certain issues. And finally, one of the purposes of accounting there was that we have to measure and interpret what's happened in a financial event, in a business transaction. In doing that, what we actually do is classify try and work out what's happened and classify all of the things that have been affected into one of these 5 groups. And we call these account types. And there are 5 of them. So there's revenue, there's expenses, there's asset, there's a liability, and there's this thing called owner's equity. So revenue. A revenue is definition there of income from performing normal business activities. So if our business is selling things, then the money we earn from selling those things is called revenue. If our business is doing haircuts or providing some service for people, then revenue is the money we earn from providing that service. So the money we earn from doing whatever it is our business normally does, that's what we call revenue. Expenses then, if we're running a business, it costs money to do that. We have to buy things, we have to buy stock, we have to buy equipment that we use, we have bills to pay. All of those costs that we incur in running our business and earning our revenue, we call those expenses. Assets are the next type. So an asset is any item that the business owns that has some value, and we know it's got value because if they wanted to sell it, they could get money for it. Right, so any item of value that is owned by the business is what we call an asset. So typically things like buildings and motor vehicles and large equipment, these kinds of things that you could sell and get money for, we call them assets. They're typically things the business uses. They buy them and use them in running their business, but they're larger items with value and they can sell them if they need to. Liabilities are liabilities if we owe money to anybody. If we buy something from somebody and we haven't paid, we buy it on credit, so we pay for it later, they become a liability because we owe them money. If we borrow money from the bank becomes a liability because we have to pay that money back. So anybody or any entity that we owe money to is a liability to our business. Owner's equity is really a special type of liability. Owner's equity, because of this concept of the accounting entity assumption, and the owner being a separate entity from the business, the money that the owner invests to start the business really makes the owner a special type of liability. And we separate out from the rest of the liabilities and we call it owner's equity. Right, so the really owner's equity represents the amount of money our business owes back to the owner if it were to fold or to stop operating. If the owner wanted to close the business, the value of the owner's equity is the amount that the business would pay back to them, if you like. So that amount can grow, it can also decrease over time, so it can change. It's really a special type of liability, and it's created because of this accounting entity assumption which separates the business from its owner. So there's a few concepts to get started. So that's it for this lesson, really. We're going to do some exercises that will start to use some of these concepts, and we'll do introduce some further concepts and build on some of these as we move on. So thanks for listening. We'll see you next time.